everybody, I'm the comment specialist. Welcome to my channel where I cover content covering various academic qualifications and professional certifications, including life-changing business ideas and concepts. Just in case if you're new to my channel and not yet subscribed, please subscribe my channel, press the bell notification button so that you get my videos on a timely basis. In today's video, I'm going to discuss IAS 37, provisions, contingent liabilities and contingent assets. So first of all, we need to understand what is a provision. A provision is a liability of uncertain timing and uncertain amount. So yes, it's a liability, but we don't know how much it is and when we have to pay. The best example is a warranty claim. Companies sell electronics or cars or any other gadgets and they do have a warranty. So they really don't know how many customers will claim the warranty, when they will claim and how much it's going to be. So the two things is we don't know the timing, we don't know the amount. That's why we call it provision. Now why do we need to understand provisions? Please understand, as per IAS 37, provisions are to be recognized and recorded in the financial statements, provided they meet the three criteria. So what are those three criteria? Number one, a company has a present obligation arising out of a result of past event, and this obligation could be legal or constructive. So now I'm going to explain you what is meant by legal obligation, what is meant by constructive obligation. So you'll be able to apply it in examination questions. A legal obligation is where there exists a contractual obligation. Means a company sells electronics, and when they sell electronics, the warranty is attached to the sale. Means once they sell, the sale has been done, there is a past event, now there is a legal obligation. So what is the legal obligation? Because you have a contract with the client, you are selling goods, you are attaching the warranty along with it. So if there is some problem with the products, the customers may claim warranty. So now you are under a contractual obligation. When you sold the goods, the agreement is there, the contract is there, it is in black and white, so it is very much legal then. Now you also need to understand what is constructive obligation. Constructive obligation is which is not legal, but over the years the company has made people understand because of their actions and decisions that they are going to do something. For example, if I am a seller of electronics, I've been selling electronics without any warranty, but it has been my practice over the years that if a customer comes with some warranty claims, some issues, I do get it done. And I've been doing it for last 20 years. Which means although I'm not under any legal obligation, but my practice, my procedures, my conduct has made people to understand what to expect from me. So this becomes a constructive obligation. The second criteria is the probability. That we have a legal obligation or a constructive obligation, and it is highly probable that to settle the obligation, an outflow of economic benefits will take place. So when we talk about probability, we are talking about a rule of thumb. We say it is probable when there is a probability of greater than 50%. That there is greater than 50% chances that to settle the obligation, whether it is legal or constructive, there will be an outflow of economic benefits. Means, let's say for example, cash would be paid to settle the claim. The third one is a reliable estimate. Can we make a reliable estimate of the amounts, the economic benefits which will flow out of the organization to settle the obligation? If yes, only then the provision is recognized in financial statement, means it is recorded. So please remember the three conditions, the recognition criteria as per IAS 37 for a provision. Number one, there has to be a present obligation, whether legal or constructive. Number two, there has to be a probability of greater than 50% that economic benefits will outflow to settle the obligation. And the third one is, can we make a reliable estimate of the amount which is required to settle the obligation? If all three criteria are met, then a provision is recorded in the financial statements. The question is, how do we record provisions? So look at the double entry. We can record provision for warranty, for example, warranty expense and credit provision for warranty. Let's say 100,000. The estimate is made for 100,000, and obviously there is a higher greater than 50% probability. That's why we are recording it. This entry, warranty expense debit, this expense will go in the profit and loss of the current year, and this provision for warranty will go in statement of financial position. And once a provision is recorded and recognized in the financial statements, we have to review it annually, whether this provision is increasing or decreasing. What if the next year we review it and we find that the provision is to be reduced? The entry will be the opposite. Let's say we found next year that the provision is not 100, but it should be 80. So the entry would be provision for warranty will be debited by 20,000, and we credit warranty expense, and obviously this will go into profit and loss. Crediting profit and loss means increasing it. This would be the double entry. Once we have understood that what are provisions, what are the three recognition criteria, how to record them, then finally we are talking about the disclosure requirements. There are two categories of disclosure requirement. Number one, we are talking about details of changes in the carrying amount of provision right from the beginning of the year, and then we are recording changes in the provision where there are additional recognitions, when there are derecognitions, any other movement in the provisions. So starting from the opening balance of provisions, looking at movements in the provision during the year, and what is the closing carrying amount of the provision. The other is, for each class of provision, we need to understand and record the disclosure relating to the background of provisions, why it was recorded, why it was recognized, what are the uncertainties relating to the outcome of the provisions, what can happen, what cannot happen. All these are the disclosure requirements for provisions. Next part of IAS 37 is contingent liability. So what is a contingent liability? A contingent liability is a liability which does not meet the recognition criteria for provisions. So if there is a present obligation but that does not fit these requirements, then it's a contingent liability. Definition as per IAS 37 for contingent liability is a present obligation which arises because of a past event whose existence will only be confirmed by the occurrence or non-occurrence of a future event which is not wholly in the control of the organization. For example, let's say there is a legal suit against the company, and there is a possibility if the company loses the case, they will have to pay compensation and damages to the injured party. So what is happening? We can see there is an obligation, but it is not confirmed yet. That's why we use the word contingency. It's a liability which may or may not turn into a liability, and may or may not turn into a liability depends upon a future event. And what is that future event? About the outcome of the case. If we lose, then we have to pay. If we don't lose, we don't have to pay anything. So obviously the decision of the court relating to the case is not in the control of the company. So we call it a contingent liability. It may or may not turn into a liability. A contingent liability may also be a present obligation arising out of a past event which is not recognized because of two reasons. Number one, it is not probable that there will be an outflow of economic resources to settle the obligation. Not probable means the probability is less than 50%. And the other reason why it is not recorded is that the amount of obligation cannot be measured with sufficient reliability. So we know, even if the probability is high, but we really don't know how much we have to pay. So if we don't know how much we have to pay, how can we record? So the rule of thumb, contingent liabilities should not be recorded in the financial statement. Instead, they're disclosed in the notes of the accounts. And if the probability at any given point of time goes more than 50%, then it does not remain a contingent liability anymore. In fact, it becomes a provision which should be recorded in the financial statement. The last element under IAS 37 is contingent assets, which are exactly the opposite of contingent liability. So the definition of contingent asset as per IAS 37 is a possible asset which arises out because of a past event, existence of which is dependent upon the occurrence and non-occurrence of a future event which is wholly or partially not in the control of the company. Now I'm giving an example of a contingent asset. We are a company and we are in a legal battle. And there is a possibility if we win the case, we will get compensation by the other party because we were the injured party, we were the affected party, we were the party who suffered losses. So is it certain that we will get the money? No, it depends upon the outcome of the case. If we win, only then we get. So it's a contingent asset. Now what to do for contingent asset? The rule is same as that of a contingent liability. Contingent assets should not be recorded in the financial statement. Instead, they are disclosed in the notes to the account. Unless it becomes virtually certain that we are going to receive the asset and the probability is high, that means more than 50%, only then we record them as an asset. Ladies and gentlemen, I hope you have understood the topic. If you're not yet subscribed, please subscribe to my channel. If you have any further questions relating to IAS 37, provisions, contingent liabilities, contingent assets, leave a comment. I will respond to you. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time.